For today's Did You Know segment, this is going to be a shout out to a number of clients that I've been assisting with over the past week because it came up in conversation so much. I've been assisting a couple clients, one in particular, but they decided to maybe start pivoting to looking from single-family homes here in North Jersey to condos. And there's quite a few implications for condos. So for today's Did You Know segment, I am going to do a deep dive on the implications of purchasing a condo and what effects that has on your mortgage process and some very important things to be aware of. So first and foremost, purchasing a condo is categorically different than purchasing a single-family home, mainly due to the fact that the condo complex and the homeowners association requires review by the lender. And there are particular guidelines that we need to follow in order to ensure we can do the financing for that property that is located in a condo complex. So I'm going to actually use the acronym here. I like to avoid it, but homeowners association is HOA. So we will review the HOA to determine the HOA's financial health, insurance policies, making sure there's proper coverages, and reserves. We look at the budget for the condo. We also will have an appraiser go out there to appraise the property. There are appraisal waivers available. If they are available, if that condo was sold anywhere between the last 10 to 12 years or so, and you have the proper qualifications as a borrower, we may not need to have an appraisal performed. But let's just assume you need to have an appraisal performed on that property as well, which appraises just that unit. Now we're going to talk about the Fannie Mae and Freddie Mac guidelines. Fannie Mae and Freddie Mac set forth the guidelines for lending on conventional loans. So we're going to talk specifically now about conventional loan financing. First, Fannie Mae will not allow more than 20% of the units in a condo complex to be owned by one single individual or investors. And that applies to projects with 21 or more units. If it's 20 units or less, there's a little bit of a different way that we look at that. But if you're purchasing a condo in a larger complex, 21 units or more, this is applicable. For Freddie Mac, though, it allows for 25% of the units to be owned by one single individual or investor, or at least up to 25%. So there's a tangible difference. Either way, you can get a conventional loan. It's just about knowing which one. That's where your trusted mortgage professional comes in to know these guidelines and also determine which loan program is going to be the most appropriate within the conventional confines. Reserve requirements. Condo associations must have at least a 10% of their budget. So when they have their budget for the whole year of their outlay of expenditures, 10% of that needs to be in reserves for most loans to qualify. So Fannie Mae and Freddie Mac need to see a healthy amount of reserves. The project eligibility, that's something that the lender determines through reviewing the finances, reviewing the structural stability of the entire condo complex where the unit's being purchased. So that's when we're going to drill into the bylaws of the HOA. We're going to drill into the finances, the budget and the reserves, and the insurance. We're going to take a look at the insurance policy to make sure that there's proper coverage and what that coverage dictates for the implications for the homeowner. Florida condos is where we need to really talk about this now. A lot of these guidelines had changed because of a higher sensitivity now to condos for lending purposes because of the Surfside Condo Complex collapse that occurred. That kind of threw up a red flag and was the impetus for a higher level of review and looking at more detailed information for condos to avoid that situation and to ensure that we can mitigate that from happening again. That also has created some more requirements for the condo complexes themselves to have proper inspections, particularly structural inspections, to ensure the safety and soundness of the structures that people will be living in. So those guidelines came out in 2021 in response to the Surfside collapse. Fannie Mae introduced new guidelines in 2022 that elevated the level of scrutiny for financials and the bylaws and the whole condo review process. Also, the reserve funding, that is something now that needed to be adopted by condo associations due to that situation that happened in Florida, so that if there is anything structural that needs to be taken care of, there's something that is in place to protect and mitigate that problem. Inspection requirements, sometimes we will have the requirement to have reserve studies performed and to verify that the condo's condition is suitable and that the capital needs are meeting the condition requirements for that condo. And there's also now an appeal process. So if at the front end, the condo, we will send out a questionnaire. And this is how the rubber meets road for this. We send out a questionnaire to the condo association for them to complete, so we can get all the information that's required, and that will point us in the direction of what further information we may need to get or further documentation we may need to have provided to us to make a determination on the eligibility of the financing for that condo complex. Freddie Mac has introduced a formal appeal process. In the event that those things don't line up, there may be suitable explanations. So that is something to bear in mind with condos as well. It's not the end-all be-all. We're just talking about conventional loans. If we look at FHA loans, FHA has a condo database that this approval process I'm talking about occurs outside of a buyer's transaction. The condo complex themselves goes through an FHA approval process where the FHA reviews everything, the Federal Housing Administration, and then they issue an approval for that condo complex for a prescribed amount of time, and it's in a database that I have access to and that lenders have access to research and understand if that condo complex is viable for FHA financing. If it's not on that condo database, fret not. There's something called spot approvals, where we essentially would go through the same process, comparable process, I should say, that we do for conventional loans, but we're doing it for our FHA borrowers. That does take some time in both of these cases, but the FHA approval process could build in quite a bit more time to get that approval completed versus the conventional approval process. One of the differences that we have here at Rate that I need to highlight is that we do have a pretty robust condo database. So for me and any of my colleagues that are currently doing business and have closed loans in certain complexes, we have a database that I can refer to, which is amazing, and I can see if we already have approval for condos, which could help expedite and also provide prospective home buyers with more assurances as they're heading into placing offers, because I can let them know this condo complex is good to go. They're on the Fannie Mae approved list or the Freddie Mac approved list. Or I can see that we've done business there 2 months ago. We just closed a loan in that condo complex. You're going to be good to go. That approval is still in our system. We can do just a quick update on some documentation and verification that may be required, and then we're good to go. So that's a limited review is what that is called, and that can help expedite the timeline for closing. Another thing to mention here is assessments. When you're purchasing a condo, you're going to have a monthly HOA fee. That is a monthly fee you're paying to the homeowners association of the condo complex for purposes of services and maintenance that the condo complex provides to you as a unit owner. This could be snow removal, landscaping. If there's amenities like a clubhouse or a pool area, your monthly HOA goes toward those costs that the HOA has to pay. There is a possible additional cost in the event that the complex needs work or needs to perform capital improvements, replacing windows, redoing brickwork, repointing the facade, things like this. And that assessment sometimes has a time period, so it won't be like your HOA fee. It's a separate fee that's still due monthly. But let's say you have a condo in New Jersey that you're purchasing and the HOA fee is $450 a month. But it has an assessment because windows need to be replaced on one side of the building. The condo association gets an estimate for that. Then they provide that estimate to the condo board, which is comprised of unit owners who've been elected by other unit owners to represent them for the management of the condo complex. And they make their determination on what they're going to do for that. And then they break it down. You say, okay, it's going to cost us $200,000, $300,000 to do this capital improvement. there's 150 units here. We're going to break that down. Maybe the condo association has the money in reserves and they just pass that cost directly down to their unit owners, or they may say they need to go and obtain lending so they can get money from a bank that they're repaying at an interest rate, and then that charge gets passed on to the unit owners by way of a special assessment. A special assessment will be however long maybe the financing is, or however long the association is comfortable with getting repayment. Unit owners may be able to pay that special assessment in one lump sum, or they can spread it out in monthly payments. So when you're buying a condo, we're going to be looking at that special assessment. If the payment is going to be required, then we're going to have to factor that in to your debt to income ratios. So it could provide an obstacle to you when qualifying and when purchasing a condo. Overall, it's very important to keep communication at a high, frequent level with your mortgage advisor so that you're aware of all of these things for the condo that you may be interested in purchasing.